Hello guys, welcome. My name is Fernandoherrera and I am in the journey to financial wellness. Now in this video, we're going to be talking about my desire to open or create a ETF type of dividend portfolio. Keep in mind that this is not your typical type of dividend or ETF where they're like safer. I'm more focused on the dividend yield, and that's what I'm going to be sharing with you guys today. First, what is an ETF? So an ETF is an acronym for exchange traded funds. Look at it as a basket of securities such as stocks. So instead of putting all your money in one single stock, you can actually buy one ETF and buy 500 different stocks. And I'm sure you've seen these videos on YouTube already where they explain what an ETF is, but I still want to emphasize again, rather than just putting all your money in Apple and Apple drops because the iPhone 12 was not popular enough and now your portfolio is suffering, you could probably put it in the S&P and pretty much, if Apple drops, you won't be affected as much because Amazon gained, right? Because they sold more diapers. So that's just a good metaphor to, kind of think about ETFs. For example, 2020 happened to be a perfect example. If you see all the travel and hospitality stocks and even real estate stocks happen to be punished severely on the stock market. And so if your portfolio was heavily inclined towards those industries, you're probably in a very pressured, stressed mode kind of way. So if you would have invested in an ETF where it's probably more diversified, you would have already had your money back where all the money that was down, it has already increased to a point where you would have not lost or you would not be losing as much right now. Since it's often time consuming to actually be buying shares from each industry yourself and managing them and pretty much, buying from Apple, from pharmaceutical, from technology, hospitality, real estate, it's always a little bit easier to just invest in an ETF because you just buy one stock and then that's it. Now, this is where ETFs become popular. You can invest in an overall industry, kind of like overall stock market kind of ETF, or you can invest in industry ETFs, which only focus on one specific industry. So you can invest in real estate ETF, and if real estate goes down or up, then that specifically gets affected. You can invest in, fintech ETFs. You can invest in banking ETFs. You can invest in all sorts of industries that you could then just buy. Maybe instead of 100 different stocks, you could just buy 8 different ETFs. Today, I'll be talking about 5 ETFs that are on my watch list all the time, and I invest sometimes in a very careful manner. The first ETF is IFGL, and this is for international developed real estate. The dividend yield on this is 7.57%, which means that every quarter you're going to be getting $7.57 for every $100 you invest in this ETF. Now again, I'm going to be talking about other ETFs, but keep in mind that at the end I have a very important message that you do want to hear, so make sure you stick till the end. The other one is PotX. And this is actually a cannabis or, kind of like industry. So if you guys know, cannabis is becoming widely popular and legalized. And I mean, there's a big market for that. So there's a very attractive dividend yield in this specific ETF. So it has an 8.44% yield, which means that for every $100 that you invest, you're going to get $8.44 every 3 months. The next one is a VNQI, which is Vanguard Global US Real Estate Developed, like real estate and something like that. But you get it, it's a real estate ETF. And the yield on this one is 7.75, which means you would be getting $7.75 for every $100 you invest, which is very good, guys. Keep in mind that for the most part, on average, you would be getting anywhere between $0 or 4%, which would be $4, and that's in a non-volatile type of stock ETF. So these are really, really good. But again, it all comes with a price, and that's risk, which I'll talk more in a bit. So the next one is SRET, which means Global Super Dividend REIT ETF, which again, there's a lot of stuff here going on, but a REIT is pretty much like a real estate trust fund, which it's like a whole different thing that I don't want to confuse you guys as much, but keep in mind that it's like just like an ETF of real estate stocks and trust funds and all that. And they just normally give high dividend yield. So SPG or Simon Property Group would be one that is considered a REIT, REIT. And so this, I guess, has like a whole bunch of those REITs, and then it kind of makes a super dividend, and then it pays out actually really well. It's a 12.22% dividend yield, which means you would get a $12 with 22 cents for every $100 you invest. And then the last one is KBWD, which is Invesco High Dividend Yield ETF. This one gives a 12.81% dividend yield, which means you would get $12.81 for every $100 you invest for every 3 months. So yeah, that's actually kind of high. Now be very cautious, guys. If these ETFs were truly gold mines, if they were truly money printing machines, then they would most likely not offer this very attractive high dividend yield. You see, in the world of investing, there's always this one rule that you should follow, and that is the higher the risk, the higher the return. And it goes opposite. It holds true for the opposite. So the lower the risk, the lower the return. And you have to find that equilibrium where you find that like sweet spot where you're comfortable with the risk and you're happy about the return. So these ETFs, yes, while they might offer a very attractive dividend yield, the stock itself might go down in value. So if you're buying one of these ETFs for $100 and you get, in 3 months, you get your $12, now you will have $112, right? But let's assume that now the stock itself is no longer worth $100, but $90 or $80. Now, instead of having $112, you probably will have less than $100, or you might have $102, $103, which for that matter, you would have been better in investing your money in a more safer stock that offers perhaps a 3% or a 4% dividend yield. And not only that, it might have even appreciated. So instead of going from $100, it would have went to $110. So these are the things that you need to keep in mind when investing in high yield ETFs. However, we can't hide the fact that these are very attractive ETFs and they have very attractive, dividend yields. So I'm very tempted in creating in the future possibly a brokerage account where I maybe invest $500 to $1,000 in all these high risk ETFs and see, kind of like an experiment of what would happen and if we would truly make some money or if we would actually lose some money and if it's a not very good choice or not. So do you guys have a good ETF that perhaps you could recommend and that offers a good dividend yield while at the same time offering a low risk of volatility? If you do, feel free to leave that in the comment section below. I would love to hear that and see, if I could probably invest in some of that myself. If you haven't already, I please ask you to click that like button since that helps me greatly. And also don't forget to subscribe if you want to see more future videos about my content. And I do appreciate you guys staying till the end. I hope you guys have a safe day and I'll see you guys next time.